There hasn't been a new asset class created since the bond market in 1693. Well, now there's a new one, and it's called the digital asset space. Question is, are you participating? Hey, what's going on, guys? It's the Crypto Siege. Another day in the crazy life that is the digital asset space. Happy Wealth Wednesday to you, my friends. Good to see you. Excited about getting into this today. Looking for some more people to hop on the stream here before I kind of get into it. But yeah, so we're going to talk a little bit about, came across a very, very interesting video that I want to share with you guys. Smooth. James in the water cooler, how you doing, my friend? Getting an error message on this. Hopefully this will go through. Crypto space has been rumbling today. What's up out of the way, Jay? Getting an error on the stream. Hopefully this streaming is working. I am getting an error message. Looks green here on OBS, so hopefully it's working. We're going to talk a little bit about the differences between, not really term and life insurance so much, but we're talking about the value add that I believe comes from some people call it cash value life insurance. Some people call it overfunded life, permanent life insurance. Talk some about that as well. James at the water cooler, how you doing today, my friend? Go over one of my books that I use, the 702J retirement plan. We're going to talk about that as well. Comedian Check Real in the building. What's up, bro? See you. I'm doing great, man. Doing really, really good. I wonder if you guys have ever heard of cash value life insurance as a tool to create wealth. I tell you, I believe it to be one of the hugely secret tools to build wealth. I really do believe that. Found out the other day that Cowboys owner, Dallas Cowboy, Jerry Jones, actually uses this strategy today. That's how he built his wealth, as a matter of fact. What up, Siege? Stimulus yet? Crypto Universe is in the building. What's up, Crypto Universe? We did indeed. I streamed earlier today, Crypto Universe, and I talked about how we like to have zero balances. So we use that too. So funny because we have balance everything. We don't have any balance, and we used a card for one on an excursion not too long. Yeah, it hadn't even been on the books for like 10 days yet. Paid that up. Just spent it on some crypto. Nice. I hear you, bro. Yeah, went ahead and made that milestone purchase today as well. Yeah, got that done. Very excited about hitting that milestone with that milestone with XRP. Tundra Music Review. What's up, my friend? Life is great, bro. Eli is in the building. What's up, Eli? On a break at work. Okay, be cool. Be safe, brother. Don't get yourself in trouble there at work. But guys, I gotta tell you, if you don't know this strategy, how to fund your own worry-free, 100% tax-free environment, we're gonna talk about that. Talk a little bit about the Celsius Network as well. I think every single time we have a Wealth Wednesday, certainly we should talk about a platform that allows you to earn money on your money, right? Earn interest on your money, and then earn interest on that interest. That's a pretty cool deal, I think. Tundra Music Review. Well, best wallet, it would be cold storage wallet. Do you have a Ledger Nano S or X as an X-ray? Tundra Music Review. James the water cooler still waiting on theirs. Yeah, vast majority of people should have gotten theirs today. Like the banks were down, systems down, phone lines down. Awake Lily's in the building. How are you? Ledger Nano S. Yes, indeed. Should be arriving this week. What's your Ledger Nano? Oh, the money. Yeah, the money's supposed to be in it. Supposed to be vast majority was supposed to show up in accounts today. So guys, we're gonna talk. I was waiting for one mullet to get on. Not sure if he's gonna be able to make it on this one. I wanted to definitely share a video with him. Any of you guys familiar with Garrett Gunderson channel? It's called Garrett Gunderson, but also it's called Wealth Labs. Your nano's coming, dude. Oh, that's the best place. That is definitely the best place. 90% of the my XRP I keep on cold storage, nanos, treasures, and the Ellie Powell, switch them up. Really important. When Mullet says I'm lurking, oh, okay. That's what I do. Split them up amongst the cold wallets. And then a big fan of the platform Celsius, so I'm using that. Earn interest on my interest. Got about 7 to 9 assets on there. Beat SOX, USDC, those types. They're earning interest on my interest as well. So, guys, listen, we're going to talk a little bit about something that I think is hugely important. And I shared it on my stream earlier today that now that we've gone ahead and hit the milestone that we wanted to make with us in digital assets, we're going to now get into another investment, and that is cash value life insurance, overfunded value life insurance. And we're gonna take some of the generally it's $1,000 to $1,500 a month digital assets. And we're gonna take some of that. We're gonna get into this investment tool, check this out, learn more about the strategy, and share this with you guys in the community. The benefits to it is just overwhelmingly crazy. Death benefits, tax benefits. It's just really, really outstanding. I'm going to share some information for 2 books from you guys. When Mullet, I didn't think this was, and I apologize, bro. I didn't check sooner. I didn't think this book was available on Amazon, but it actually is available on Amazon. So this is a good read. I got it through Palm Beach Research Group. It's by Tom Dyson. It's called the 702J Retirement Plan, but it is actually available on Amazon. Great read. I got this one. This is a simplified version. Delay on this thing is massive. Money, Wealth, Life Insurance by Jake Thompson. This is a simplified version. I'm going to start with this. But I came across a very, very interesting video of the difference between, buy term and invest the difference, and what you would earn in investing in an overfunded cash value life insurance, permanent life insurance, structured the right way. The key to it all is that it has to be structured the right way, because the vast majority of people in that business, in the whole life business, don't know how to structure it. They're not even familiar with them at all. So you have to know the right people to get into it. So that's the Money Wealth one. But when Mullet, the other one is actually on Amazon. The other one, the 702J, is on Amazon also. You have to search Tom Dyson or you could try searching the title, The 702 Retirement Plan. Yep, there you go. Absolutely great read. But I'm going to share some things from this book, from these books, and then I'm going to share a video. Again, Garrett Gunderson, Wealth Labs on YouTube, comparing the difference, the actual real difference, real life differences between the two, and dispelling one of the biggest myths. And, buy term and invest the difference. So, yeah, real excited about that. I think it's absolutely golden. So let me share just kind of some of the, everyone's kind of familiar with insurances, but they're not familiar with the differences in the benefits. So, and that's really kind of the key. So these are called cash value life insurance. So, no, supercharged savings with cash value life insurance. And the tax options are crazy because you can grow your business, you can grow your account, tax growth, tax free, which is absolutely amazing. Like, a lot of people don't understand it, but you can do that. And the added benefit of the death benefit as well. And so that's really massive. Tax-free growth. I don't know about you, but I'm worried about taxes. Most people give up more to income taxes. Now, so among many benefits, let's talk about a few of those tax benefits. First, and arguably one of the most important, is the tax-free growth. It's pretty simple. Growth inside an insurance policy is called a dividend, and by definition, is considered a return of premium. Since they are considering it a return of what you have already paid, it is not taxable. It's not taxable. Primerica, great company. I actually know the CEO. Great company. Absolutely. So a lot of people don't know that. So it's termed a dividend. This is the law, financial law, whether it be the SEC or the CFTC that whoever oversees the life insurance industry. The returns that you make from that is dividend, and by law, it's not taxable. So you can grow the cash value in this cash value life insurance tax-free. So that being said, there's one caveat. As the policy grows, you will have undoubtedly accumulated more than you contributed if you designed it for high cash value. At any point you decide to withdraw your money from the policy, growth can be taxable if you do it the wrong way. That's the key. You got to know how to do it. So there's withdrawals, and then there's the loan option, which is significantly better. So we're going to go over those. So the withdrawal versus loan. So the fundamental difference between a loan and a withdrawal is that the withdrawal is a withdrawal of your money, while the loan is a loan from the insurance company. By contract, the insurance company guarantees the ability to borrow money up to the amount that you have in the cash value. And that is the key. The difference between withdrawing and taking advantage of the loan. Now, I shared a couple days ago, I think it was, what was the guy's name? Someone was in the stream. I forget the guy's name. And I compared to what I was able to do when I was an employee for the federal government. When I had what they would call a TSP, Thrift Savings Plan. And of course, the day you walk into the federal government, within a week, you're sitting and talking with the person that's going to help you set this 401k. It's not even, obviously it's an option. They can't make you do it, but that's one of the first things they do, right? And so I had discovered years later, I don't know, 10 years later, maybe 8-10 years later, that after I had been contributing, that you can actually borrow take a loan on your money, okay? Take a loan on your money, pay it back. You set up a plan to pay it back in 1 year, 2 year, 5 years, whatever. And you're still earning interest on the, on the money that's in there. But when you make your payments, you're making interest on those payments back as well. So you're paying yourself back and earning interest on that money. And of course, you can take the money and do what you need to do. And they actually have now what I'm going to say somewhere between 2 and 4 different ways that you can borrow your own money without being penalized, for taking it out. You can borrow it versus withdrawing it in the federal government. And these cash value life insurances, most people know them as whole life insurances, you can do the exact same thing. It's the exact same concept, except for with my TSP and 401k, there's no death benefit to that. There's no death benefit to it, right? So I mentioned a couple of things on yesterday's stream that I want you guys to really look into. I encourage you guys with everything, every fiber in me, to get those 2 books that I put up there. And that Win Mullet is always so graciously taking his time to make available. I hope you guys saw the links in there. I encourage you with every single thing in me to get those 2 books. I what did I do? I resubscribed Palm Beach Research Group so that I could get access. Aiden Trading, what's going on, brother? Good to see you, young man. Good to see you in the stream. How you doing today, bro? So that I could get access to what they call income for life experts, right? These are people that are experienced 50 plus years and structuring this policy in the correct way. Again, the biggest challenge is the vast majority of people in the space, not just in life insurance, but whole life insurance, don't know how to structure these properly because, again, they have a Miss Life Insurance at home and little life insurance kids at home too, right? Just like I have a Miss Crypto Siege and a little Crypto Siege at home, right? They do too. They have a family as well, and they're trying to feed their family. And I'm not saying that there's intent. I'm not saying that. What I'm saying is that unless you instruct them and advise them on what you want this policy and how to be structured, they're not going to just offer it up to you, because in the beginning, which is what the broker is looking at, is less commission for them, significantly less commission for them. So you see what I'm saying? That's kind of the thing. But if you know what it is that you want and you know how to structure it, I'm telling you, it is one of the greatest tools ever. And major companies, major banks, major corporations use this strategy all of the time. All of the time. It is absolutely golden. Absolutely golden thing. So, 2 things that I want to share with you guys. If you know some mutual whole life insurance people, if you know some whole life insurance people, ask them if they know what a PUA is, PUA, and if they know what a MEC limit is. Deep Mind is in the building. What's up, brother? Good to see you. Hello, Siege. What's up, family? We'll be sitting back in the class taking notes. Smash that like on the way in. So I encourage you to ask them. And I'm going to share a video of 2 guys that explain the difference. It's a fairly lengthy listen to, but I think it's really important to check out the scenario, check out the real numbers. Win Mullet, I would love for you, if it's free, he's going to mention a website that has a calculator where you can actually put these numbers in for yourself. Right, so you all can put these numbers in for yourself. Go back to the video, check out the numbers and learn kind of the difference. And this is so important. So very, very, very important to understand the difference. And again, I don't think there's malintent. I just think there's lack of education. So I wouldn't say that the whole life person who doesn't bring up a PUA or an MEC limit okay, and doesn't bring up these things and talk about them, that is, I'm not saying there's a malintent. I'm just saying that you're going to have to educate them on what it is. So a PUA, this is so important to see. So the difference is insider secrets for slashing fees on this policy by up to 70%. Okay. And here's a great point. Regular agents often set these policies by applying 100%. And I went through this with the guy who works at Liberty Mutual, right? So Mutual, right? I went through it and I said, look, this is what I want. I want to look. I didn't mention the PUA, the MEC limit. I went in there as though I was just a person wanting whole life insurance. That's it, right? I didn't tell him what I knew because I wanted to see if he was going to share with me the options. Now, I told him our family goals. Told him that, what we're doing here is we like to use this as a very much as an investment account, and so that we can, all I said is so that we can do more things and have more tax benefits. But this is something that is going to be a family account that's going to be, and we're looking to have this account for decades. So myself, Miss Crypto Siege, and our daughter, who's at the time she was 17. She is 17. And what he came back with, he came up with an overfunded. He said, you can put 50 or, you can start out at 50 or 100 or $250, and then you overfunded, different thing like that. But he never mentioned the reduction in commissions for him if you do a PUA rider, and he never mentioned how to set up that PUA rider so that you don't go over your MEC limit. Never, ever mentioned it, because regular agents often set these policies by applying 100% of the premium payment to what insurance companies call base premium. And that's exactly what he said. Again, nice guy, right? Met with him several times, talking about different things, getting to learn more about what he does and what we do. Young guy, fiance at home, that type of deal. Never mentioned it, never brought it up, right? Never brought it up. So allocating all of your premium payments to base premiums will get you the maximum amount of insurance or death benefits possible if that's all you're after, right? So it's important to know that. Allocating all of your premium payment to the base will get you the maximum amount of insurance or death benefits possible if that's all you're after. And there are some cases where that might make sense, right? But base premiums are two negative things, and they're interrelated. First, maximizing your base premium, you'll pay the highest amount of commission possible to the insurance agent. Because of that, the cash buildup in your policy during the beginning years is horrible, almost non-existent, right? Almost non-existent. So he gave an example of a 35-year-old first year annual premium is $10,000. One of the great things about these is there is no minimum or maximum, right? So if you don't have 10,000 lump sum, 20,000 lump sum, 50,000 lump sum, it's no worries. You can start out with $50 a month, and then after that 12 month, that's your first 12 months, right? So you can start at $50, you can start at $100 a month, you can start out at $200 a month, $500 a month, whatever it might be. So, but here's the challenge, right? So 35-year-old first year annual premium of $10,000 is zero cash value. Now, this is 100% of the total premium goes to the base premium. 100%. $10,000 to the base premium. Cash value is zero. This person is 35 years old, so their death benefit is $998,000. People look at that and like, whoa, 35, cool. Death benefit almost $1 million, right? But what they don't tell you about is this thing called a PUA, which is paid up additions. It's something called paid up additions. And what that does is that allows you to adjust the base premium amount that you're paying out. That's the difference. It's called a PUA. Okay, so instead of an agent can collect to allocate a large percent of your total premium to this PUA rider. So they can split that 10,000 and they can say 7,000 towards the base, 3,000 in cash value. It's called a PUA rider, paid up additions rider, PUA. Want to do your homework, right? You want to do your homework. 3,000 towards the base premium, 7,000 towards the PUA rider. You can set it up in any way that you want. And the way that would look is 70% of the total premium goes to the PUA rider. So annual is 10,000. Cash value now is 6,832 cash value. You're 35 years old. And the death benefit now is 324,450. You're 35 years old. That's one of the benefits. It's learning about the PUA. That's one of the benefits. Learning about this PUA is massive. Guys, get these two books. I promise you, it is the difference. XRP number 1 says, who was taught money management and given investment advice at school? And why is that? Exactly. What's going on, guys? Yep. Paid up. It's called paid up additions, right? So it's PUA. You adjust it, right? Paid up additional insurance is additional whole life coverage that a policyholder purchases using the policy's dividends instead of premiums. Yep, that's exactly right. Yep, that's exactly right, Win Mullet. Good stuff, my friend. The key to this whole thing is educating yourself about what a PUA is, PUA rider. Okay, absolutely massive that you understand that. And then it's also it's massively important that you understand what an MEC limit is. Got to know what the MEC limit is. Anybody familiar with what MEC stands for? The MEC limit. Crypto Siege, do you know what this is called in Canada? Oh, Derek P. I do not, my friend. Derek P., what's going on, bro? It's good to see you, Miss XRP Gal. It's great to see you. The Crypto Caveman is in the building. Eli makes a great point here, guys. Eli says, isn't it their job to educate us on their life insurance? You would think. You would think, right? It says, yes, we are to be knowledgeable, but wouldn't we know all of the deals they have unless they teach us? Correct me if I'm wrong. The challenge is that they don't, Eli. The challenge is that we really have to educate ourselves about the deal, the real deal. Thank you, Win Mullet. Modified endowment contract. Thread work, Derek. Good to see you in the stream, brother. That's the challenge, Eli. It really has become incumbent upon us, because the insurance agent is going to say, "Well, I gave you what you asked for." Because again, the insurance agent has a misinsurance agent at home, and has a little insurance agent at home. You know, so I don't really fault them. Right? So you want to learn about the modified endowment contract, MEC limits. Important to find out what they are and what they do for you. And this is something that the IRS put together back in 1988. Because what they were finding is that people were overfunding these policies so that they could get the tax benefits and not using it, and not really using it as a life insurance in terms of death benefits. These big corporations, they caught on to it, these fancy finance people caught on to it, and they were just overfunding, right? Take advantage of the tax-free growth and not the insurance part, the death benefit part of it. So they came in, the IRS came in 1988, and they said, no. You're gonna have to have some limits on this whole building up this cash value thing, because you're not really using it as life insurance. You're using it as a tax-free haven for investing, right? So they changed it. Now they have this thing called the modified endowment contracts. But here's the key: you can add value, add cash to these policies as long as you stay under that limit. But you have to know what they are. You have to know what the limits are. And if your guy is not bringing it up, if your guy or gal is not bringing it up, then you're not kind of getting the benefits of it. All right. So here's the thing: every insurance contract comes with an illustration of what the MEC limit is. Remember, that's the summary of your premium payments, cash value, and death benefit. Now, my guy brought that to me. He shared everything with me, the numbers from this age to that age, but he never talked about the MEC limit. He never talked about the 7-pay premium test either. Right. So, and when mullet, you never want to exceed the MEC limit, but you're going to have your guy explain to you what the MEC limit is. You're going to have to ask your guy, can you tell me my options with a PUA right? I'd like to add a rider to this policy. How can we get that done? What are my options? But you have to know it. XRP Gal, that's exactly right. XRP Gal says, at Crypto Siege, I did life insurance in another lifetime. There you go, guys. Many agents will sell you what is most profitable for them, not necessarily best for you. This is from someone who is in the industry, right? This is someone who is in this industry. She knows. And again, I don't think it's a malintent. I just think that they have a wife and kids at home just like you and I. They have a significant other at home and children just like you and I. And so you have to come to the table prepared for what it is that you want. What it is that you want, right? Here's the income for life policy set up using a P rider. So, great examples in these books, guys. I would encourage you again to get both of those books. Now I'm going to cover the big thing, the big myth and buy in term and invest in the difference. And I'm going to let someone else cover it for you guys so you can hear this conversation. I think you're going to really, really enjoy it. I think it's going to be an eye-opener for you. XRP number 1. I'm from Europe. None of this applies. Oh, wow. Just here to listen to Siege. Well, thank you, brother. I appreciate you being here. That's right. And you have to pay attention when mullet to that MEC limit. You have to be on that. And hopefully you're working with people who are familiar with it and know how to structure it and keep you up to date and abreast of what's going on. You have to, that is part of your due diligence, is paying attention to it. I don't know why I'm having some issues with the stream. XRP number 1. In my experience, they sell you what turns the best commission to them. Yeah. Exactly. All right, guys, hopefully I'm gonna let you check this thing out here. Hopefully this will work. Hopefully this will work, guys. I see I'm buffering here, and I don't know why. I really don't know why. And the fees is crazy. So let's see if this works, guys.
He's talking about this debate going back and forth. The cost for 250. In the 90s, and they still think that's how it's going to be.
All right, guys. So hopefully I refreshed the page. So hopefully this is going to work better.
But the reality is that's a dream, as Tim would say here. You know, that probably going to turn out to be a nightmare. A lot of people that are quoting these past times of the market that don't even exist today, and they feel some false sense of security when they're just going down a road to ruin. At the same time, there's people that just have immediate bias towards any type of product that's either something that they've seen designed poorly or that they've heard someone else do that maybe wasn't done right, and maybe they've even done it themselves and it just didn't quite work out how it was supposed to. Everything in finance is susceptible to this. And I've seen bias because people invested in the 90s and they still think that's how it's going to be. But the reality is that's a dream, as Tim would say here, you know, that probably going to turn out to be a nightmare. So we had someone comment on the YouTube channel, and the comment, it comes from Seth, and he said, let's run some numbers to see how that turns out. He's talking about this debate going back and forth. The cost for a $250,000 whole life policy for a 40-year-old non-smoking male, the preferred rate class can vary from product to product and company to company, but one quote from a reputable company I represent is about $347 per month. In 20 years, the cash value is guaranteed to be $70,018, but under current values would be $105,721, with the death benefit growing to $326,000. So the death benefit grows over time in most policies. So the cost for a $250,000 20-year term policy using the same parameters would be as low as $23 per month. So what if you took that difference, or $324 per month, and invested over 20 years at an 8% annual return? That's going to turn out to be $190,000. So clearly, the buy term and invest the difference strategy is superior. What about the rest of the story? We've brought a computer and a whiz and someone that really knows how to build this software, someone I learned from decades ago, Todd Langford with Truth Concepts. I know you want to give him a shout out. Yeah. Let's demonstrate this, Tim.
Perfect.
Not just throw some concepts that are half-baked.
Yeah, and I think, you know, this is a common misconception that I see all the time. And one thing that kind of became clear is he's either not aware of how to actually design the policies properly, right, or he's using the wrong company, or a combination of both, right? Because
so under this premise, so totally understand these numbers.
Yep.
But what about taxes? What about actual rates of return?
Yes.
Are you going to buy term insurance? And what? Okay, so he talked about the cost of that.
Yep.
You know, what happens to that term after that time? Yeah.
So I want to start off right away with market history. I'm going to use some software built by Todd Langford. It's called the Truth Concept software.
Awesome.
Amazing software. Love Todd.
Yeah, definitely talking fast. So the Truth Concept software. So the Truth Concept software is the software that I was talking about, guys. The Truth Concept software by Tom Langford. I don't know how to spell his name, so I put parentheses because I don't know if it's the Truth Concept or Truth Concepts software, or if it's Tom Langford with the E or without the E. Am I buffering again? So there it is right there. The truthconcepts.com calculator. There you go, guys. All right, so I'm going to try and play this video again. Hopefully this will work. So I'm turning my mic off.
and what he does. So the first thing when on his investment return, I want to kind of debunk that right away. He says, if I get an 8% market return, he should have started with once upon a time, I got an 8% market return because it's a fairy tale.
Okay.
So if I pull up 20 years,
most people are still saying 10%.
Yes.
I mean, when I say most people, I'm not saying informed or uninformed. I'm just saying I still hear that all the time.
Yeah, exactly. And I heard that all the time when I started in finance, right? 8% was the most common number thrown out there. But
I always think of average return like standing in a shower with two shower heads, turning one freezing cold, the other one scalding hot, and being like, on average, I'm at a lukewarm temperature. But in reality, I'm miserable as hell, Tim.
Exactly.
That's the reality, right? Exactly. Averages aren't always the actual.
Exactly. So in the software I have loaded in front of us right here, I've got the market history for 20 years. Now, I had the reporting through 2018 in the software, not through 2019. Okay. So I went from 2018 back to 1998. The average for the Dow Jones was 6.22%.
Wow. 6.22. So you're looking at actual rates of return in the market.
And that's the average over that time.
Yep.
If we actually go through and get the actual return, though, and go through and show every year that there was a gain
because volatility makes a difference.
Yep.
Because if you lose 10% on 100 grand, now you're down to 90 grand. If you gain 10% the next year and there's no fees and no taxes, you're only back to $99,000.
Yep.
So your average return's zero, but your actual return is in the negative.
Yeah. And so in the market on that scenario, when the positive, you get exactly what the positive is. On the negative, it's a more impactful negative, right? It impacts you worse than what it says it will.
Right.
And just as you demonstrated. So the actual return over that same 20 years, instead of being 6.22%, is actually 5.34.
So 5.34 versus 8%. Yep. So, I mean, let's just think about, like, I would love to run that number. Is what's 100 grand do at 8% over 20 years? What does 100 grand do at 5.32%? It's drastically different.
It is drastically different. Do you want to do?
Yeah, let's do it. Let's pull it up. While you're pulling it up, so we're here to kind of really look at this with a more critical eye, tell the rest of the story, give more information so that people can make an informed decision.
So if we start with $100,000 and we say, okay, we're not going to put anything into it, but we're going to now get an 8% return.
20 years.
And we're going to do that for 20 years. Then we are going to end up with $466,000.
Okay, 466.
Now let's go ahead and do a new calculator of that same thing right next to it here. And we're going to give ourselves $100,000. We're going to give ourselves, though, a 5.34% rate of return. And we're going to give ourselves 20 years. We end up with $283,000.
That's a big difference, Tim.
That's just a small difference. Yeah, that'd be fun, right? So you start the story with once upon a time, but you can't end with lived happily ever after because it's not actually a fairy tale anymore. It's a horror story. You just don't find out about the horror story for 20 years.
Right.
Right. And now it's kind of too late. We also haven't calculated fees into this thing yet. We haven't calculated any tax ramifications of this thing yet.
Right. And I get you might be able to put it in Roth IRA.
Yep.
You know,
that will solve the tax
so that's
thing.
fair. You might put it
the
into a retirement plan like a 401k, but you're going to pay taxes when you pull that out.
Yep.
You know, so that may or may not
brings in a tax deferral risk.
Yeah, as long as taxes stayed level, it would still be okay.
Yeah.
You know, but ultimately we have some issues there.
We definitely have some issues there.
And you have no term insurance anymore.
Yep.
Which here's the problem: when you don't have insurance, you use your assets as insurance, which is this like notion of self-insured. But if you have to use your assets, it means you're spending at least $1 for every dollar of insurance, if not more.
Yeah.
And when I buy insurance, I like to spend pennies on the dollar. But if I have to lock my money away, I can't utilize it. I forfeit the ability to earn a full rate of return because I can't risk it. I can't be volatile. I can't pay it down. I can't utilize it. And so it kind of gets locked away. And we'll do more videos on that concept alone, but that's a big thing.
It is a huge thing.
All right, so what's next?
So let's go ahead and do a buy term invested difference against a whole overfunded whole life policy. I'm going to use some of the same numbers that he brought to us in the question. Now, I feel like he didn't have either the right company or the right understanding how to structure the policy.
Right.
So he came up with $347 a month.
Mm-hmm.
That equals $4,164 a year as a premium payment.
Okay.
So I went ahead and ran a policy on a 40-year-old male, preferred, properly set up at $4,200 per year.
Okay.
What I came up with was, so I ran a 20-year number or 20-year scenario here, $4,200 a month in the policy. Instead of only having $105,000 in cash value on the actual, we have 132. Right.
Okay, so we're already 105,000 versus 132.
Yep.
That's almost a $30,000 difference.
And then he started with about a $250,000 death benefit. I started with 370.
Okay, so you actually got more death benefit.
More death benefit and more cash value for the same price. Right. And so this was what I consider to be
in a low interest rate environment.
Exactly.
Right.
Now I just showed the initial, just the first 20 years, but the person, if he starts at 40, is not done at 60. So I want to show more like let's go out 30 years. Let's go out 40 years and see what this thing does. Okay. So let's take it out to 80 and just see what happens. Now, this is assuming he's going to continue to put cash in it the entire time. Most likely not going to do that, but he's going to end up with a $496,000 of cash.
Mm-hmm.
He's going to have a death benefit of $686,000.
Right. For those people that have read What Would Rockefellers Do, or they go to freewwrd.com and get the book, you can see that the death benefit can actually benefit you in 6 different ways while you're alive to boost your cash flow. 20% to as high as 50% more with other dead assets, lazy assets, things that aren't providing cash. So that's really cool in addition to the cash value. And I think once we unlock that human ingenuity and understand how big corporations use this to benefit, long-term in a very tax-efficient way, there's 2 chapters that are really phenomenal that way.
Absolutely. And it's a huge benefit to have a permanent death benefit that's guaranteed. There's a lot of ways to leverage that. So that's something to keep in mind as well. Now, I can now take this, and this shows me down here at the bottom right or left side, you'll see an internal rate of return on the life insurance cash value is 4.51%. So that cuts through all of the fees. It cuts through all of the costs on this policy and says this is what it actually did over that 40-year period was 4.51%.
Okay.
Now, I can take that and copy it. And the reason I want to kind of click on it and copy it is because now I get all of the different decibel points.
So his numbers were 190,000 if he bought term and invested difference plus.
Yeah, he'd have 250,000 of death benefit.
And 250,000 death benefit that goes away.
Yep.
And then he said that our numbers would have been 105,000. Turns out they're 132,000 over that 20 years with $370,000 of death benefit to start that grew. So we're actually a lot further ahead than he talked about, and we'll come back to this 190,000. But right now we're just looking at a 30-year and 40 years, what happens, and it's up to over 4% return with tax efficiency.
Yeah. So now I want to find showing a buy term invest a different scenario. And I'm going to start with it earning that same exact interest rate that I just got from the whole life insurance. So I'm going to paste that number in there.
Okay.
You'll see that it's $4,200 a year.
Okay.
You'll see that the death benefit in 40 years, or the cash value in 40 years, is equal. It's the exact $496,739 because I did the same number. Right. But now we have to bring in the term cost, the other costs that happen here. Right. So a lot of times in this other scenario, whether it's a Roth or something, a lot of times it's managed money. There's fees. What do you think is a fair fee for me to throw into this number?
Look, some people might use index funds like Vanguard, so that could lower it. If it's a managed fund, they're paying at least 1%.
Yeah.
So
let's start with 1. Well, we can show a half.
And we can always lower, but
we can
1.
do some different things. But I think 1 is a pretty standard number for a lot of managed accounts, and most people have a managed account, right? So if we do that, this now bottom left number shows us how much the alternate account would have to earn just to equal the whole life.
Okay.
Because you'll see the cash value now dropped to 381 instead of that 400 and let me see, what was it exactly?
492. Well,
it was 496.
496.
Put a 1% fee on it. Now we get 381 instead. So if the alternate account wanted to keep pace,
and this is a big thing because when we only think in percentages instead of dollars and cents, 1% seems minuscule, but it's consequential.
Yes.
It could be catastrophic in a big way. Like we're talking about over $100,000 difference, and you're thinking, 1%, not a big.
All right, guys. So that's kind of what I wanted. That's why I kind of wanted to do 3 things here, guys. So one is reference the book so you guys can get the books and learn about it yourself. Please let us know if you didn't get the links to those 2 books so you can learn about it yourself. Okay. I also wanted you guys to kind of hear a scenario. This is a real life scenario because a lot of people espouse to believe, have been told about the buy term and investor difference without doing their own homework and own due diligence and actually running the numbers and seeing the difference, asking questions. And that's exactly what happens. They know enough to say, so what are the when you're sitting down with the person on the side of the table, you say, well, what are the fees? And what they always do is they tell you the percentage. When you're looking to do your IRA, your Roth IRA, your 401k, TSP, whatever, they tell you the percentage. They'll say 0.5%, 1%, 1.1%, but they never tell you how that works, how it's calculated. What are these fees based upon? 1%, they never tell you 1% of what. They just say 1%. And a lot of times what they do is they show you that upfront fee, and it's minuscule. Why is it minuscule in the beginning? Because your account value, the money that you put in, is minuscule in the beginning. They don't tell you the real deal about the fees, and that's the challenge. They don't tell you the real deals. Now, I'm going to try and share something from the book that I emailed to myself, and hopefully this will give you a great illustration of the real deal when it comes to fees. Hopefully it'll tell you the real deal. What's going on, Elizabeth? Good to see you. Crypto Don Juan, what's going on, brother? Let me see if I can share this the right way. 62. I need to be. I went the wrong way. I can't share it. But I'll just have to I'll have to share it with you guys. I can't share it. It didn't work. I have to share with you guys the real deal on the fees. It's the biggest lie in modern finance. You'll find this, guys, on page 55 in the book, The Real Retirement Plan, 702J, The Real Retirement Plan. You find out the real deal about the fees. You know, that's the challenge, is that most people don't know the real deals in these fees and these Roth IRAs or these bond mutual funds. They don't know what the real deal is when it comes to the fees. Right? And so there's a great comparison between this whole life policy and a policy or an asset like a Roth IRA or a mutual fund, kind of the fees and different stuff that you pay. It's really, really, really fascinating, because the way it works is the 1% in the mutual fund or bond mutual fund is on the account balance first year, right? So it's on the account balance, but your account balance goes up, and that it's 1% of the total account value. Where with a whole life insurance policy structured properly, you pay a higher fee in the beginning, but the fee is based on what you put in. It's based on the amount of money you put in. It's based on the amount of money that you put in, and it goes down over the years. So the way it works is the front-loaded fees that you pay in the beginning is about 33% on your first payment, and then it goes down to 5% for like 9 or 10 years, and then it goes just down to a 1% maintenance fee on the remaining of the policy. But it's based upon the money that you put in. It's not on the total accumulative balance, the total accumulating balance, like they do in a mutual fund, on mutual, etc. index funds, whatever those fees are in those type of assets, where they say it's 1% fee, but you're paying a 1% fee on the accumulating balance of your account. Versus with this particular structured policy, you pay a higher amount in the beginning, but it's based on that premium, the premium money that you put in, 5,000, 10,000, 50,000, whatever you put in. But then it starts out high, let's say 30 or 33%, but then it goes down to 5% on the amount that you put in. So whatever you put in. So let's say year 2 through 9, whatever you put in. If you put 10,000, it's 5% of 10,000, right? And it goes down to eventually it's just 1% of the remaining policy, a maintenance fee. But it's every year, it's what you put in. You put 10% in, you put 10,000, 1%. You put in 20,000, it's 1%. But in 30,000, it's 1%. It's not 1% of 30,000, 20,000 plus 10,000, 60,000. That's the difference. That is the difference. And so the way it works out, I'm going to read it to you. So here's an example, right? So this is what this guy actually did. So year 1 through 4, he put 50,000 in lump sum. So what he did is for years 1 through 4, you structured your account with 4 annual lump sum deposits of 50,000 per year. So this guy put in 50,000 lump sum every year for 4 years straight, right? So, and you then started at year 5, moving onward, you deposited 17,500. For the first 4 years, you put 50 grand in each year. 50 grand, right? So years 1 through 4, 50 annual. Years 5 through 50, 17.5 annual. This is what this guy did. So over those 50 years, you'll pay a total of $1,005,000 into your policy. This is what the guy did. Started out with large, right? 50 grand. Boom, boom, boom. 4 years. So in 50 years, you'll pay $1,005,000. And through the magic of compounding, it'll be worth $5,700,000. $5,700,000. Okay. Again, starting out first 4 years, this guy is balling. He's putting 50,000 in each year, right? 50,000 in each year, right? And years 5 through 50, he's only putting in 17,500. Okay. So here's the fees. You're paying fees, commission as follows. This is what the numbers. This is back whenever he did it, right? So year 1, these are the fees for this policy, this structured policy that I'm talking about. It has it here in this book. $7,494 the first year. Year 2 through 10. Here's the key. Years 2 through 10, $875 in fees and commission per year. Years 2 through 10, $875,000. That's not right. $875, excuse me. $875 per year in fees. First year, $17,000. Right? All right, so let's go through that. Years 11 through 50, the commission and or fees. Years 11 through 50 is $175 per year. $175 per year, years 11 through 50. So over 50 years, you will pay a total of $34,319 in fees to the insurance agency that set up the policy. Real life example, running the numbers. Over 50 years, $34,319 in fees. Okay. And so what he did is he said, well, then I got this guy, Tim, to calculate, the kind of the buy term and invest in something like a mutual fund, a low cost bond fund, or an ETF, right? For example. So what he did is he went to Morningstar. And he said, he called them an annual expense ratio for a bond mutual fund is 1%, according to Morningstar. For bond mutual funds, 1%, right? So to contrast that, the average expense ratio of a mutual fund offered by our company's 401k plan through Fidelity is over 2% per year. Many other mutual funds have similar costs. So what he did is, so let's assume that the bond generates the same long-term return, which is roughly 5%, 5.2%, and that the annual growth your policy projects each year over this 50-year period after fees. So you're going to calculate the fees and you're going to calculate what you would be earning at 5%. So here it is. So he said he used the same amount to deposit into this bond mutual fund. Years 1 through 4, $50,000 annual, because that's what he did in his life insurance. So now he's going to put it in this bond mutual fund. Years 5 through 50, $17,500 again. So the total cumulative amount is the same that you invest, right, over 50 years, $1,005,000, right? Same amount invested, right? Through the magic of compounding, your account would be worth $5 million. Same, $5,700,219, right? Now, let's check the fees out. So you'd pay a fee every year, and the fee would get bigger every year as your account grows. Okay, so this is the thing that people miss. In year 1, you pay $526. So you're thinking, man, I'm good. Only $526 in fees, right? Year 2, you pay $1,074 in fees. Probably didn't even notice the difference that it almost doubled. Probably won't even notice it. In year 3, you'd pay $1,645 in commission fees, right? In the first 10 years, you'd pay a total, first 10 years, of $25,189. First 10 years, right? First 10 years, right? 35-year-old person. In the first 20 years, which I think is the most realistic number, 20 years sticking with something, 20 years sticking with term insurance, 20 years sticking in a bond, mutual fund, or whatever it might be. 20 years, I think that's a perfect number. In the first 20 years, check this out, guys. You pay a total and cumulative fees of $88,326. $88,000 in 20 years. In the first 30 years, you'd pay a total cumulative fee. Get this, guys, 30 years. Right? Most people not checking. What are most people checking on when they check on their policy? They check on the investment. You know what they check on? They check on the balance in their account. They want to know how much money their money is making for them. They're not even paying attention to the fees. So in the first 30 years, it goes up to $205,742 in fees. In the first 40 years, it goes up to $404,000 in cumulative fees. $404,000. So how much would you have paid in total fees over 50 years? 50 years? Like something probably maybe Miss Crypto Siege would do, or my daughter would be doing, right? $727,000 in fees. That's over 20 times the $34,000 you'll end up paying in life insurance fees over the same period. $720,000 in a bond, mutual fund, slant 401k, ETF, or $34,000 in fees over the same 50-year period. Guys, those are the facts. Because again, two things. We ask what the fee is. They're going to give you the percentage. They're going to give you that 0.5%, 1%, 1.2%, 1.5%. They're going to give you that number. I'm going to tell you what the first year is. Why? Because it's so low. It's so low because you just started that bond, mutual fund, ETF thing or whatever. So it may be $200, $300, $400, a few $100, right? And I'm telling you, the vast majority of people never, ever pay attention to the fees They go to their site, they call their broker, they get online, and they go check the balance. That's what they do, guys. They go out and they check the balance. That's the reality of the situation. They don't pay attention to the fees and commissions. They never think about it. They're only concentrated on their balance. And the only question they know to ask in the beginning is, well, what's the fee? What is the fee? What's the commission? Whatever. They give them this low number, 1%. They tell them, because that's generally what it is 0.5% to maybe up to 2%. They tell them what that's going to cost in the first year. Everyone's like, cool. Well, it's only a few $100s. Cool. They never think about the fee is based upon the cumulative balance of that account. They never, ever think about it. So here's the other most important thing. More importantly, that 1% mutual fund fee caused a difference of more than 1.8 million in the final account value. The mutual fund investor has an account with 3.9 million. The income for life policy has an account value of 5.7 million. That's the reality of the situation, guys. Guys, listen, I hope you guys take the time to get these books and educate yourself on what the real deal is, guys. I hope that you do. Win Mullet, thank you so much, brother, for everything you do with this channel. All the mods, I appreciate you guys big time. Go out, just do yourself a favor, guys. Go grab these 2 books. Listen to XRP Gal. She told you she was in that space at one moment in time in her life. Gary Gunderson on YouTube. And the title of this particular video is Term Life Insurance Better Than Whole Life with a question mark. You can even do /Wealth Labs if you want. Listen to that video over and over and over and over and over again. Grab these books. Educate yourself. These are really quick reads. This is 100 pages. And this one is like 50 pages maybe. Yeah, I mean, this is 50 something pages. I'm telling you, you're gonna thank me later. Hopefully you grab these books. You're gonna thank me later for educating yourself on what the real deal is. And again, guys, I am going to purchase, structure, and put together one of these policies. I'm gonna say by the latest, like May 2nd or 3rd, by the latest. And I can't wait to share this with you guys. Share this experience, share with you what the policy is going to look like. And, I'm going to start fairly slow. It's going to be $500 or less a month, most likely $500 or less a month, which means I'm going to shrink my digital asset investment from $1,500 to $1,000 probably, or from $1,000 to $500, depending upon the month, depending upon the woman of my life wants to do, the love of my life wants to do, right? But yeah, and I'm going to share this with you guys. Reading, listen to the description, Will, I will definitely do that, brother. Thank you. Guys, educate yourselves. It's not about being right or wrong here, guys. It's about being knowledgeable about what it is that you want, so that when you go to the table with these people, you get what you want, not what they want to give you. And we can't know what it is that we want from them unless we know what it is that we want, which means we have to educate ourselves, guys. Give the titles of the books again, says TJ Jackson. Okay, so the first one is the 702 in parentheses J, the 702 in parentheses J, retirement plan. And it is by Tom Dyson. That's exactly right. Gucci Girl. Was it Guac Girl or Gucci Girl? I would say Gucci Guac Girl. We don't know what we don't know, and therefore we don't have, which my mentor used to say to me. So the 702J retirement plan by Tom Dyson. And then Money, Wealth, Life Insurance. This is a quick, simple read. So this is a good foundation, but you definitely want to read the first one first. So Money, Wealth, Life Insurance by Jake Thompson. Jake Thompson. Yeah, Guac Girl. My mentor used to say to me, "You don't know what you don't know, therefore you don't have." Because if you knew what you didn't know, you would have. Because to know and not to do is not to know. And we don't want to be in that situation, right? We want to learn from my past mistakes. We want to learn from the lessons of my mentor and figure out what it is that we don't know so that we can do something about it. Lloyd, his name was Lloyd, successful realtor, Frog in the Well. What's going on, good brother? Good to see you, Frog in the Well. Right? So that we can do something about it. And again, I'm not encouraging you guys to go out and do something. I want to help educate you guys so that you know, so that you can make your own decisions. So you can make your own decisions, right? And so what we're going to go do is we're going to talk with this guy from this the Palm Beach research group. They have something called they call them Income for Life Experts is what they call this group. Income for Life Experts. I'm going to LLOID. A big L and a little L, XRP LABA. We're going to sit and talk, and we're going to tell them our situation. Just like I told my guy. I'm going to tell him my situation, and I'm saying, look, this is the deal. I'm going to tell him the whole deal. What I'm looking to do, everything, right? And I'm going to share with them, look, you have an opportunity. I promise you, this is what I'm going to say to them. You have an opportunity to have 50 to 70 years client. You have an opportunity to have a 50 to 70 year client. But in order for you to do that, you're going to have to put this policy together structured with a PUA rider that does not exceed the MEC limit. I want to know what can I do initially? If one policy, because this is what it's feeling like to me. One policy, that's the policy. Now, if you come up, let's say when moon, let's say what happens if when moon is Christmas of this year, 2020. Well, now, significantly more initial investment that I can put. What does that mean? That means I have to get another policy. I have to go out and get a separate, and you can. The great thing about these things, you can get as many policies as you want. As many as you want, and there's no minimum. You can start out with $50 a month and just start it. Look at it, see it. So I'm 25. I got $50 a month. At the end of 12 months, what's my death benefit? What does that look like? Is there any cash value? What does that look like, right? All these different things. Thank you, Will Munnett. Very, very important. Paid up additions rider, MEC limit, modified endowment contract limit. These are things that you want to get yourself familiar with. So when and the other key to this as well, and they tell you that in both of the books, you got to find some companies that's been around for a while. You got to find some people that know how to do it and are familiar with it. That's why I'm going to Palm Beach Researchers Group and their Income for Life Experts. And I'm going to talk to them directly. I'm going to talk to them directly. I do have a friend, a real good friend, not the first guy I talked to. He's kind of an independent guy. I may give him a shot. But, I'm going to have to vet the people that he's going to, because he's like a broker, right? He can find different mutual companies, and blah, blah, right? I'll give him a shot. I'll give him a shot to see if he can win our business. But if they're not familiar with how to structure it, I'm going to to the Palm Beach Research Group, Income for Life experts who have been doing this for nearly 60 years. That's where I'm going, guys. So I can't wait to share this journey with you guys. Forgive me for all the buffering issues with the channel. I appreciate you guys hanging out. I hope this has been valuable to you guys. I know you're going to enjoy these books. I'm telling you, it's going to be an awakening for you. You're going to get excited about it. Because you guys can start this now at a young age. Go ahead and get the, get the physicals and the health checkups done while you're young. And again, another trick in this book as well is you can set this policy up for anyone. It doesn't necessarily have to be you. So if you're in a situation that maybe you're 55 or 60 years old, and you want to still be able to have most cash value, you can set it up on someone else, maybe your child or someone else like that, where you're going to get better death benefit, if you will, overall, which will end up being going to them more than likely. But in either case, you now have a significant difference in cash value as well. So a lot of different avenues that you can do. Number one, you can have as many of these as you want, and you can be paying for something, but you can be insuring someone else, which is really, really cool. Grab this calculator, thetruthconcepts.com. If you're comfortable enough with being able to work with that and put your own numbers in as well, guys. All right, guys, listen, thank you so much for hanging out. I'm going to go grab some dinner. It's been a really cool hang. Another edition of Wealth Wednesdays. Jet_digital, it's good to see you, my friend. Frog in the Well, appreciate you being here, brother. Thank you so much, Win Mellon and TJ Jackson. It's always a great hangout. Guac Girl, appreciate you hanging today. I know there's a Kimes called Guac Girl. Hope that's right. XRP Lava, thank you so much for hanging out. All the people that take the time to hang out today, I definitely appreciate that. Tons of music review. It's great to hang and see you today, my friend. Crypto Don Juan, it's good to see you, brother. Elizabeth, thanks for hanging out today. All right, guys, listen, I'm going to wrap up this video like I do all my videos and remind you of this. Old money does not want you to win. They don't want us to win. They would rather us remain a cog in their perpetual wheel of trading our time for dollars. They don't want us to play in the same playground that they play in, where we allow our money to work for us. This is our chance to win, guys. The digital asset space is our chance to win. We are in the midst of the greatest transfer of wealth in the history of man. Are you participating, or are you standing on the sidelines? Here's what I do know, that the battle for you has already been fought. The victory is yours. Go get it. I'll talk to you soon, guys. See ya. Bye.